I think it was a decent quarter for the Canadian banks. Not sterling, obviously, because of the higher gross impaired loans and higher provisions for credit losses related to energy, which is finally starting to hit some of the asset qualities of these banks. That has also kind of bled over to the consumer area, especially in those oil patch regions where credit cards and auto loans are starting to see some stress, for which is a negative for the banks. Some of the other things that we saw this quarter were the fee revenue areas like wealth management and capital markets are still struggling. Wealth management because the markets were kind of malaised, and for the capital markets, that's where most of the energy lending occurs. So the higher provisions impacted those segments. RBC had a decent quarter. Much like another bank that we're going to talk about, it benefited from an acquisition, a U.S. acquisition. It's acquisition of City National in California. So we saw much better personal commercial revenue and net income from that area. But like all the other banks, capital markets struggled with higher provisions for losses to energy, and wealth management was actually better because of the City National and the assets that they brought along with that acquisition. BMO had a decent quarter with varying different pulls and pushes that occurred on the income statement. On the positive, they like Royal Bank benefited from a U.S. acquisition for transportation finance that it acquired from General Electric. It saw much better U.S. segment growth, much better U.S. segment in net income as a result of that. On the negative, though, they, like all the other banks, had stress with their energy portfolio. And secondly, they incurred some restructuring charges related to more technology and branch rationalization as people move towards digital use of their banks. TD had a decent quarter. I think TD benefited from its much lower exposure to energy compared to the other banks. Personal commercial in Canada and the U.S. remained very solid, much like the other Canadian banks during the quarter that really kind of carried the day for all of them. And generally, we were okay with generally pleased with TD's quarter. So not much to criticize there. CIBC saw a pretty significant impact on its gross impaired loans and provisions for losses on energy. They too kind of carried through by the Canadian personal commercial banking, which remained very solid for them. And some of the fee management areas like wealth management kind of struggled, and they're in the process and will. The full impact of the sale of American Central will be reflected next quarter. Scotia, again, one of the higher exposures to energy, but they, like the other banks, benefit from strong personal commercial in Canada, as well as the strong growth that they continue to see from the international business. That's done very well for them and continues to lend stability to the overall earnings. Overall, I think we're still kind of cautious, not only with Scotia, but with all the banks on their energy lending. And we're kind of keeping an eye on that. National pre-announced a significant provision for losses, pretty much wiped out probably about half their normal net income for the quarter. They provisioned $250 million for bad energy loans. They also struggled, they're very intensive in capital markets. They also struggled with some of the capital markets business that they had there. Overall, kind of a tough quarter for them. I think they're hopeful that they've addressed all the energy issues, but I'm not so sure about that. We'll see what they do next quarter. I think we're still going to see some stress from some of these energy portfolios. They're really coming off very low impaired levels. I still think we're going to still see higher provisions in that area. The Canadian personal commercial banking business will probably still be very solid, but we're going to probably see lower growth given the slowness in the overall economy. For the banks that have U.S. presence like TD and BMO, I think they're going to do generally better than the rest of the banks. And capital markets activities will probably be a little bit better as the market's done better, but not like what we saw a year ago.